let me share my screen and start my presentation. Actually, on the left-hand side, you will see when you follow the chapters and slides, I'm generally starting from the left-hand side and continue with the right-hand side, and I'm mentioning the dynamics on the graphs. This is the global trade, year-over-year growth, as you see, and it is the 3-month moving average changes, percentage changes. As you see in the graph, this left-hand side, this gray line represent the global trade activities year-over-year growth rate, and in the 2 shrinking period, you will see that this is the 2008 global financial crisis that started in the United States and spread over the world. And during this time, as you see, the global trade activities approximately shrink 20% year-over-year. And also you should look at the PMI manufacturing activities. This is also a leading indicators what is happening in real market. First of all, when we are speaking about the global trade, PMI activities, industrial production, these type of activities are called as real market activities. So I'm not speaking about the interest rate, inflation rate, global bond yields, or global equity returns. These are financial market indicators. They can manipulate, they can increase or decrease easily. For instance, if the United States started a quantitative easing operation, or ECB decreased the interest rate, you can see direct changes in FX market, in bond market, and in stock market. This is easy. But in real market indicators, it is a little bit slow and sticky. For instance, you can easily change the interest rate and deposit rates and saving in the banks just with one decision, by increasing or decreasing the interest rate. It is easy and it is simultaneous. Their effect is simultaneous. But in real market, the effect is a little bit with lag effect. First, the financial market adjusts, and then the real market indicators follow those adjustments. The PMI, as I say, first, the gray line as represent the global trade, and the PMI manufacturing purchasing manager index, PMI called as purchasing manager index. This means that, let's say you are owning a factory, you are taking the orders from the local and international market, and purchasing manager index saying this. You are making a survey, you are somebody asking a question, and question is in this style: what is the changes in sales in local market during the last month? Or they are asking this: what is your expectation for the next 3 months for the revenue growth? These are real market indicators, and purchasing manager index calculate these activities. So on the left-hand side, as I say, the global trade activities decreased 20% approximately during the global financial crisis, as you see. And here, this shrinkage, 2 crises we have during the last 2 decades. The first one in 2008 global financial crisis, and second one in 2020, the COVID-19 crisis. During these activities, we have a really recessionary effect and shrinking in the economic growth, global economic activities, supply chain constraints. On the left-hand side, as I say, the global trade shrink 20%, and PMI also decreased to 30 level. By the way, you should keep in mind that the threshold value for the PMI index is 50. So if the PMI index above the 50 level, the economy is in the growth cycle. But if it is decreasing below the threshold 50 level, the economies, real economic indicators showing a decrease and slowing growth rate. As I say, they are cyclical, as you see on the market dynamics. They have a huge real correlation. They increase at the same time and they are decreasing at the same time. When we focus on the last year, right now, the current situation, The global trade activity is also in a decreasing trend, as you see, because here, after the COVID-19 crisis, it shrinks approximately 15%, then it increased approximately 20% because of the base effect, because lots of orders stopped and delayed because of the COVID crisis. Lots of producers want to see what is happening next and stop their ordering, stop their sales. Then after the COVID effect passed away, then they started to increase hugely their orders and their sales, and this increase for that reason. Generally, the average is around 5%. So we are in the below of the average for the last 20 years for the global economic trade activities. And most importantly, the PMI manufacturing index is also below the 50 level, the threshold level. For that reason, we are saying that these are all a good and strong signal of the recessionary effect in the market, because lots of people expecting a recession in the global financial and real market. For that reason, they are stopping their orders, they are stopping and delaying their production. For that reason, this cycle is in the downward sloping. And export growth, as you see, export growth also has a similar dynamics with global trade, but there is a little bit difference between developed and emerging market. As you see, the export growth also shrinks in the global financial crisis, and it shrinks in the COVID-19 crisis directly. Then, when we are focusing on the changes in the emerging and developed markets, advanced economies, the developed market has a little bit high volatility because it decreased more than emerging market and it increased higher than emerging market when we focus on export growth and shrinkage. Because, as you know, the advanced economies are export-oriented economies. They are producing, right? They are producing and selling the products. For that reason, any economic cyclicality has a high sensitivity in developed economies rather than the emerging market. And right now, the emerging market decrease more than the developed market because lots of capital outflow occurring from the emerging economies to developed market, and the production processes is a little bit slowing down in emerging market. Because if we speaking about the recessionary effect, this effect will be high sensitivity in emerging markets rather than the developed market. For that reason, still the export growth is positive region in developed market. It is in negative side for the emerging market as well. Please look at this slide. This is the global supply chain and supply chain pressures calculation. As you see, in the first row, we have supply chain pressure index, and in the below, we have global shipping cost. In the third one, the China containerized freight. In the fourth one, Port of Los Angeles loaded container ratio. The next one is semiconductor lead times. These are all the input and output prices, and emerging market Asia output, emerging market input prices. So what we are calculating here as we speak about the supply chain constraint, it is this. You own the Apple, okay? Apple, knowing that the input cost, worker cost, chip cost, all is cheaper in the Asian, Indian market, China market. So rather than employ a worker in the United States and paying $5,000 in a month is a really huge cost, because we know the revenue function of the Apple is this, not the revenue actually, the total profit function. Total profit is equal total revenue minus total cost. My total revenue is not dependent because I'm selling to the United States and the rest of the world, but my total cost function, I have a sensitivity. I have flexible about that. I can open my factory in Luxembourg, in United States, in Texas or California, or I can open this factory in Shanghai or China or India. If I open this factory in Luxembourg in the United States, the one person unit cost for the workers is around $5,000. My cost is higher. But if it is India, it is $1,000 and my profit is going up. For that reason, I'm opening lots of my center is in the United States, but my operation and production is in the Asian side. So we have a huge distance between United States and Asia. And I have given lots of orders from our customers to the rest of the world, all around the world. Then they all order to MacBook Pro and iPhone Max, right now. Then if there is a global supply chain constraint, if there is a problem in global supply chain, normally one order from the United States delivered to the customer in 10 days. But right now, it is reaching to the customer in 1 month or 2 months because market is closing. Everybody is at home. Okay, they are not producing because of the COVID crisis. They are not going outside. They are not demanding something. For that reason, supply chain constraint increasing. There is a pressure in the market. What is bringing? Let's say we have 10 customers and MacBook Pro is $2,000. And Apple saying that because of supply chain pressure, all orders will be delayed 1 month. And one of the guy who has how can I say rich man, okay, saying that I'm opening to pay $5,000 if you give my orders in 5 days. Then because of this, we have the product and customer differentiation. People who accept to wait 1 or 2 months and pay the normal prices, and people who are not patient and pay the prices higher. So I'm giving priority to their orders and the prices increases in the market. Okay, so if there's a supply chain pressure in the market, you should keep in mind that this will have an inflationary effect because the prices will go up. The orders will be delayed, the shipping costs will be increased, the prices will be increased. Okay, so this green line showing the supply chain is not good, especially in the COVID period, it is red, but right now it is covering, it is recovery period in the global market dynamics. The whole supply chain is in the green region right now. Still, for instance, semiconductors, especially the inputs for some chips, auto industry, still in the supply chain pressure in the international market. As you see, what I said a few minutes ago about the supply chain constraint, this is also bringing another cost. What I say, if there is a supply chain pressure in the market, this will bring an inflationary cost to the market because lots of people directly giving order because they are impatient, they don't have time to wait approximately 2-3 months, so they are ready to pay higher prices. Also because of the constraint and because of the borders, because of the pass away cost, because of the oil cost, because of the transportation cost, the shipment cost is also going up. So because of these type of supply chain constraint, the breakage in the supply chain side, this will bring an inflationary effect. And as you see, we have the market here. This is below the trend line, and this is the above trend line. As you see here, we have developed market. As you see the emerging market, and we have the other emerging market. We have generally called this market as better than the emerging markets, but highly volatile markets, financially fragile 5: Brazil, South Africa, Mexico, Turkey, and Russia. These are the fragile financial 5 emerging market economies. And as you see, after the global financial crisis 2008, the market is recovering and the inflationary trend is on the middle average. But right now, it is all in the red line. In all markets, not just in EM, not just in other EM, but also in developed markets, the inflation is above the trend line. What is the reason behind that? The supply chain pressure in the global market. So if one ship from California or Los Angeles, I don't know, from that side, reach the Shanghai as it is before the COVID crisis, this inflation trend will be turned to this path. But if the supply chain pressure continues, this inflation trend will be above the average trend line. What is the reason? What is the basic reason behind those activities and why those type of things happening in international market? First of all, we should understand that we generally have production and consumption side of the economies in the market. For instance, lots of European Union countries are the production economies. They have huge saving, they have less consumption, they are producing and they are exporting. They are rich. Okay, they are rich. They are producing everything. For instance, you are sending from South Africa tons of banana, tons of full of ship of banana just to get one machine or one Mercedes automobile from the European Union. So they are producing highly value-added products. They are producing and they are exporting. And their international trade line is in the growth and export oriented. For that reason, they are rich. But some economies, consumption oriented, especially in Asian side, because there's a huge population growth in those economies, because you couldn't see the huge population growth in the European Union. It is around 0%. Sometimes in some region, it is shrinking. The population growth decreasing. They are taking immigration like Australia, like Canada, like Germany, like Norway, or like Finland. Because there is no population growth and consumption is really low and stable. But in Asian side, in China, in India, in Turkey, or in Arabian Peninsula, we have huge consumption side economies. For that reason, if the production doesn't come from the European Union or the United States or Canada or Australia, the prices will go up. This is by basic demand and supply condition. We know this, right? We have demand and we have supply. If supply decrease, if the products given to the market, if the services given to market decrease, the prices will go up. If the Europe, if the United States, if the Canada does not produce something, or it is not delivered to the market at the commitment time, the prices will go up. And look at this picture right now. The prices of oil, Brent oil, it is USD per barrel. Okay. And what you see in this graph. First of all, from the 19 to the 20, okay, 19 to the 2000, approximately 10 years, it is around $20 per barrel. It is so stable, so low. Then a huge increase until the financial crisis in 2008. It is $20 in the beginning of the 2000, and it reached before the crisis approximately $140 per barrel. It is huge, and this is inflationary. And market cyclicality goes in this line. For instance, let's think the economies like an emerging market. You are not producing petroleum products, you are importing those products, and you have depreciating currency. If you're importing the oil, and if the oil prices is going up, if you're heating your house with oil and natural gas, your prices and your inflation will go up because the oil price is going up and your currency is depreciating. Double effect. Okay. Then, during the global financial crisis, all demand shrinks. And from the $140 per barrel, the prices of oil decreased to $40. This is good to market. Inflation gone up, recession, deflation. But there is no consumption in economies. Everybody precautionary about their savings because there is no deposit rate that is giving a positive return for your deposit. There is a huge inflation in the market, and the return, the interest rate offering from the banks is just near the zero, but there's a high inflation. The nominal return is around the zero. When, as I said, when you are calculating the real return in the market, you should take the nominal return and the minus the inflation price changes. Okay, this is the real return. So if there's a huge inflation in the market, your real return about your investment is decreasing. For that reason, the United States and global advanced economies started the quantitative easing process. They print huge money. They started the asset-backed securities and mortgage-backed securities buying program from the market, approximately $40 billion in each month. And this means that I'm buying government and treasury bonds from the market, and I'm giving the excessive dollar to the market. What does this bringing? This bringing this. If you give huge dollar to the market, the dollar price will be decreased. Basic demand and supply. If something is excessive amount in the market, its price decrease. If the shortage in the market, its price increasing. Okay. If there is huge dollar in the market, the dollar price is decreasing. If you look at this period for these 3 years from 2008 to 2012, 3-4 years, all emerging market economic currencies are appreciating against United States dollar because there's excessively huge amount United States dollar in the market. Because United States government saying their citizen this. We faced a huge global financial crisis. Nobody is consuming. Nobody is creating a demand, and we are not growing. For that reason, I'm giving the cheaper money, zero cost money to you. Please consume and create demand. For that reason, after this creation of the demand, as the demand increase, the oil prices in international markets start to increase and reach approximately $130 per barrel again. And it is gradually during 3 years around this. Then it started to decrease again to $40. But what happened here? This is directly the COVID crisis. By the way, when the COVID crisis and forward contracts, the future contract of the oil prices, I see the negative. Minus price of the oil. This means that if you are ready to take 1 barrel of oil from the Los Angeles, and if you are ready to pay those transportation costs, I will give to the oil, 1 barrel oil to you with minus $10. If you buy, the company will be paid to you additional $10. You will not pay anything. They will give you to $10 because they have a cost to storage, because they have a stock cost. Okay, for that reason, they want to sell everything. Then, after another quantitative easing period, asset-backed securities, mortgage-backed securities, quantitative easing period, the oil market started to increase. And what happened here? This huge increase, this is the Russian-Ukraine war. This region is one of the most prominent region in the world for the oil production, especially the natural gas production. And because of the war, lots of sanctions started to United States and European Union against Russia. And they don't even import any barrel of natural gas or oil products from the Russia. And it stopped. Then Russia said that if you get out my country from the SWIFT and international financial system, I will not give any barrel of oil, even for the countries that they need, not just European Union or United States, but even the countries, neighborhood countries, I will not give any barrel of the oil. If the supply decrease, the prices increase again, as you see. Basic demand and supply condition. And because of this effect, the oil price again increased. And right now we are here. Again, $80. Because the Russian-Ukraine war recovery started, and European Union and United States find alternative ways from Iran, from other source of the oil producers like the Arabian Peninsula, Iran, and those countries. For that reason, oil prices start to decrease. And let's look at these natural gas prices. It is same. As you see, the Russia is the highest producer of the natural gas. And when the Russian-Ukraine war started, the natural gas prices increased approximately, as you see, around the 350 euro. Huge, 5 and 7 times higher than the average. If you look at the 10 years average, it is around 20. It is approximately 13 or 16 times higher than the average. This is a disaster for the global economies because everybody heating their houses with natural gas. Everybody producing natural gas for the electricity. Is somebody making something on the screen? Antonella, could you control the people that is making some drawing on the shapes?
I don't think anyone has the permissions to do that.
But somebody drew two line on the shapes, on the graphs. I don't know who is that. But anyway.
I don't know.
Let me close this and share this again. Because somebody is there, draw some pictures on the graphs and I couldn't follow. Here we are again. As you see, as I said, just look at the picture here. The United States and European Union, and because of the neighborhood to the Russian market, the European Union natural gas market has a huge inflationary effect. The price is going up approximately 16 times higher than the average. And the oil supply. Okay, you should look at the oil supply, millions of barrels per day. Who is producing oil in the market? The United States, Russia, Saudi Arabia, Iran, Iraq, and OPEC. By the way, we couldn't see Venezuela and those type of region because of the sanction, they are not sharing all of their production. But as you see, the rest of the world around the 30%, and OPEC around 12%, Russia around 10%, and United States around 12%. So, especially if Russia, United States, OPEC cut the production, you will see huge increase in the financial market for the oil prices. Because always keep in mind, basic demand and supply. If something cut it in the supply side, the supply decreasing and the prices increasing. Okay. And here, it is really important, the US crude oil inventories. Look at the inventories. It is the gray line on the left-hand side, and it is the rigs count. What is your thinking? What happened here? What happened here? Because you are not importing oil and natural gas from the Russia, because you put sanction to the Russia and you directly prohibited to import from the Russian market any oil products. So to compensate this loss, because you need oil, right, to make production, to heat houses, even to produce electricity, you need oil and natural gas, right? If you couldn't use those type of inputs, you can't make any production. So if the import from Russia decreasing, you should compensate this with something. Either you will produce oil or you will use your inventories, okay? And United States start to use their inventories, and their inventories decrease approximately from 1,200 to 800, approximately 30% decrease in inventories, because they should use their inventories because they are not importing from the Russia. Okay, and inventories in the financial market and global market also decreased during this time, because you couldn't buy anything from Russia and you are using what you have at your hand. Okay, there is no other possibility. And we should also look at the commodity market. What we are saying about the commodity market. The commodity market consists of these type of things. Commodity is everything. Oil is a commodity. Gold is a commodity. Iron ore is a commodity. Aluminium, copper, nickel, zinc, all these type of things are commodities in the market. Okay. And commodities generally used even for eating. For instance, cyan beer. Okay. And for instance, the cotton. Okay. Basic cotton is a commodity. And we have derivative markets for cotton. For that reason, if there is a problem in commodity market, we will directly feel those type of things in our houses, in our wallets. Okay. If the increase in commodity prices felt in the financial market, we will feel this type of increase in the real market indicators with a lag effect. As you see here, because of the COVID crisis and because of the Russian war, the iron ore prices from $90 increased around $220. This is the iron ore cost. What is iron ore? Iron ore is everything. If you are making an infrastructure on your street, if you are building houses, if you are building skyscraper, you need iron ore and steel, right? To make any infrastructure, to make any wall, to make any building. These are the basic inputs for the infrastructure and housing market. So if the cost of the iron ore doubles, this means that the input cost for infrastructure and housing market will be double. So house price will increase. So just think this: you are the producer of the house product. Okay, you are building the housing in the United States market, and you are competing your cost, cement, okay, water, electricity, iron ore, steel, and the worker cost. And this is around, let's say, 100,000. And suddenly one of these costs, iron ore, doubles here. So if the house is $500,000, now it should be $600,000 because your input cost increasing. You are not getting iron ore with the same prices, it is increasing. So to build up a house, costly for you, and you should increase your sale price as well. And this is inflation, as you know. Okay, so if the commodity market in international market is increasing, you should know that this have an inflationary effect. The same here as well. As you see, the blue line, no, not the blue one, but the gray line is the 2001. As you see in 2001, we have COVID effect, and in the orange 2022, we have the Russian war effect, right? In the March, started to invade the Ukraine, and all commodities, and this being inflation. After that, as you see, when the developed and emerging markets find the alternatives and cut their production and find other alternative sources for their production for the compensation of the China steel production and iron ore production in these type of markets, the prices started to decrease and turn their average trend line. Other metals. Please look at the metals prices right now. On the left-hand side, you are seeing gold prices, the USD per ounce, okay, the ounce of the gold prices. This is the orange line, okay. The gold, how the gold prices affect in financial market. For instance, let's say United States saying that we are decreasing the interest rate because of there is a recession in the market. This will directly increase the gold prices because volatility, fear, all these type of things trigger the demand for the gold, because gold called in the international market as safe haven. Okay, safe haven. You are in the safe haven. Because if you put your money into the stock market, they have huge volatility. In one day, it is increasing 5%, it is decreasing 2%. If there is recession, it can decrease 30%. But the gold, it is safe haven. Okay, if there's a fear in the market, if there's a volatility in the market, gold prices is rising up. And the gray line, the treasury inflationary protected sovereign bond yields. What does this mean? It is showing the nominal yields minus inflation. So if inflation is going up, if inflation is going up, the treasury protected inflation protected sovereign yields will be rise, because they are protecting you against inflation. So if inflation is going up, you should offer higher yields for your customers, because they should be better off or as they are before the inflation. For that reason, the gold prices and treasury inflation protected sovereign yields will behave in the same cycle. And on the right hand side, the metal prices, as you see, the copper, aluminum, zinc, and nickel. What is happening here? Look at this picture. Huge increase. Why? Because of the COVID crisis, every commodity prices is rising. Look at this picture. What is happening here? Because of the global financial crisis, all commodity and metal prices is rising, and this will bring inflation. Because after this 2008 financial crisis and COVID crisis, all central banks and governments around the world started to rescue programs, started to asset buying, mortgage-backed securities, asset-backed securities buying program, and this will bring inflation. So everybody knows that if there is huge money in the market, they will buy something, and one of them is commodities, and demand for commodities increasing and their prices rising hugely. And on the left-hand side, we have the global currencies. As you see, the global currencies year-to-date return versus United States dollar. Okay, this is showing year-to-date return. For instance, for the Brazil, the Brazilian real appreciating. For the Indonesian rupee, it is appreciating as well. But in the fragile financial five, as I say, Turkey, South Korea, Mexico, their money, their currency is really depreciating. And if your money is depreciating, and if the commodity prices is also going up, you will feel inflation hugely and deeply, because you are buying higher cost with higher money. Okay, so this will be a double effect. And here, as you see, the United States dollar index. What we mean by United States dollar index? This is called the XY index in the in the financial market jargon. It is called the spot USD index, and it is calculated with 6 currencies. Okay, 6 reserve currencies: Euro, GBP, Japanese yen, Swiss franc, Canadian dollar, and Australian dollar. These are the 6 reserve currencies. They have a basket, 60% from Euro, and approximately each from them 8%, and the totally 100%. And if the dollar index getting strength, Euro decreasing, Canadian dollar decreasing, Australian dollar decreasing, Swiss franc decreasing, GBP decreasing. Okay, so the US dollar index showing the strength of the dollar in the international market. And lots of people also worrying and wondering about this question, crypto market, because this market is really new. We should know that this. If there is a stability in the market, if everything is okay, if everything is good, crypto market has a stable outlook. But if there is a huge money in the market, as I say, in the COVID crisis, what the United States made, they buy $85 billion treasury bills and government bonds from the market every month, $85 billion. Cheaper money, zero cost money, and they are giving to the customer, they are giving to the banks. And with this cheap money, look for the commodities, look for the investment. And one of them is cryptocurrencies. During the COVID crisis, they approximately 6 times higher than their average prices. But after the United States saying that we are increasing the interest rate and we are converging our market indicators to the real return rates, now it directed downward with the 10-year average price line. Okay, so there is no free lunch in the market. You should just follow the trend and cyclicality. If you catch this trend, it is okay. But if you get the cryptocurrencies at these prices, you should really wait, maybe even 10 years, even by buying at this cost and decreasing your weighted average cost. And here, as you see, there is a volatility, the volatility of the stock exchange and cryptocurrencies, the S&P 500 index and Bitcoin. As you see, the Bitcoin, because of its manipulation, it has open to manipulation, its volatility is high, but index, as you see in the COVID crisis, has a huge volatility as well, but volatility now around to 20% because the recessionary effect and COVID crisis pass away. As I say, VIX, this VIX is a Chicago Board option rate, generally called the fear index in the market. If the VIX is increasing, the stock prices decreasing, gold prices increasing, because everybody has a fear and they look for the safe haven for their investment. And the MOVE index, this is the Bank of America Merrill Lynch fear index as well. They have same direction and same cyclicality. And during the recession, as you see, if there is a recession and if there is a fear in the market, the VIX volatility index, fear index, will be reached their highest level. And the correlation between stock and sovereign bonds, weekly rolling correlation of US equities and treasuries, as you see, 6-month correlation and 1-year correlation, they have huge correlation and their correlation is in the negative side. What does this mean? Generally, the correlation, if the equity is rising, the treasury yield will be going down, or vice versa. So the equity stock market is in the reverse correlation between the US treasuries and fixed income yields. And the last one, because I will give time for you to ask your question about your wondering, global energy prices, as you see, on the gray line, we have gas, on the blue, we have the oil, on the orange, we have coal, and on the light blue, we have renewable energy. What this graph showing us? We are transforming our economies and our world for the renewable energy market, because renewable energy market don't have a shortage. They don't have inventories. We shouldn't dig the soil. And every day we shouldn't find something new under the soil, and we shouldn't finish those inventories. Renewable products, because of the dependencies in the international market between countries, they try to find their own ways. Just think this. During the COVID crisis, we understand that dependency on China for production is a disaster. If the China closed their country, nobody finding anything around the world because they are producing everything. So they should find their ways and they should decrease their dependencies for their energy market. And they found the ways for the renewable energy products and renewable energy products is hugely increasing in financial and global real market. And as you see, again here, renewable energy transition in United States, $1 billion. As you see, the green line is the renewable energy, and this one is storage of the electrification, carbon, etc., the traditional energy market. And the green lies in upside trend, and the traditional is in the downward trend. For that reason, for the next years, for instance, for the next 10 years, in 2030s, we will see that lots of products today we used with oil, natural gas, and other type of things will be converted to electricity or will be converted to wind or the renewable energy. So dependency to China, dependency to Saudi Arabia or Russia for the oil products will be decreasing as well. So this is the end of my presentation. I can take your question. Here I see some question. Impressive. You are making okay. How this topic can help villagers to their community? Actually, I don't know how this topic can help villagers to their community, but I can directly say this. In commodity market, because lots of commodities are producing by countryside, in villager side, and I don't think they will have a direct effect. They will have a direct effect on their community about the villagers, but this can be think in this way. The rural population in the market, in the global economy, will be decreased because this also create a dependency for the city center, for their production, for their energy consumption, for those type of things. And maybe in the next couple of years, next couple of decades, the village population will increase again like in the 18th century. Can the inflationary trends be described as import inflation? Exactly. Generally, the inflation trend coming from the commodity import from the international market. And because of the commodity prices rising up in international market and the currency is depreciating against United States dollar, this create a huge inflation because of the exchange rate pass-through from the import prices.
Question, you can question or leave a comment in the chat as well. Okay, we have a question from Lumbayi. Let's see what they have to say.
Hello, Antonella. Hello.
Helen, we can hear you.
Okay. Thanks for giving me the word. So I just wanted to know, as talking about inflections and any kind of global marketing. So why is it that most of the country we have to follow dollars, like if the fluctuation of dollars, we have to follow it. Other country, they can also do their own economics, like in marketing. So why is that?
If I understand the question correctly, why we are following the dollar index and why lots of countries following the dollar as a
Yes.
Yeah. Okay, this is
the
basic.
leader, like is yeah.
Petrodollar economy established in 1970s, especially after the not the 2000, but after the Second World War, petrodollar economy. And if you are importing commodities, if you are importing the energy, oil products, all products prices is calculated according to United States dollars. Because after the Second World War, US get the strength and decide and determine these prices. But what is happening today? Russia and emerging market, especially the China, in Africa, in Asia, using their local money in international trade. Like we have dependency in oil production in Russia, we have dependency in fragility of the currencies as well. For that reason, lots of countries making agreement between their international trade to use their local currencies. Okay, because they don't want to depend on the United States dollar, because they are not printing the United States dollar. They create a fragility. For that reason, the countries and the world also converting at that side. But today, you can't say Brazilian real or Turkish lira used in international market, because we have reserve currencies, and reserve currencies have 6. Just the Chinese yuan entered the basket last 2-3 years ago as the 7th reserve currencies. So the Indonesian rupee are not a reserve currency. No central bank put their reserves in Indian rupee, because they are not accepting as the reserve currencies around the world. To get a reserve currency, you should have a strong economy. Okay.
Okay. Wow. Thank you so much.
We have another question from Charles. Let's see what he has to say.
You are unmuted, Charles. Charles, you are muted.
In the meantime, we can answer the question from Frank Firi.
Okay.
Hi.
I beg you kindly send the some notice on this presentation by ... Okay. What is real cause of inflation? Let's go above and look at the question in the chat. What is the real cause of inflation? I mean, its origin that I may lead to scarcity of goods in the country. The basic reason in the inflation is money supply generally. Credit growth. If you have huge money in the market, and if you have money to spend, they will create demand and they increase the inflation. If you cut the money supply, if you cut the credit and loan side, nobody will find any money to buy something, and this will decrease demand and inflation in the basic side. And the next question, how can international economy affect a country? This is direct question. The international economic condition, for instance, if there is a huge inflation in international market, you are importing goods from the international market, and if the price is higher there, the prices will be higher in your country as well. If you are not North Korea, okay. If you are interconnected with international market and global economies, the changes and developments in international economy will directly affect your country because of the globalization. Okay. Now I can take, Charles, your question. You are unmuted now.
Okay, my name is Charles Osango. I'm a student in geophysical science. In geophysical science, we learn on how to discover oil and gas.
Mm-hmm.
But I've seen many countries in Africa who have discovered oil and exporting more.
Mm-hmm.
Why is those countries still have a problem of inflation in terms of finances? They cannot finance even their projects alone, and they still source for donor funding. Why is that so happening?
Okay. This is basically about the balance of payment. We have in balance of payment current account, financial account, and net official reserve. Balance of payment is always in equilibrium. And current account, what does this mean? Trade, your export and your import. And the services, your investment in international market and their investment in your country. You are subtracting these and you have a current account. Then in financial account, we have lots of portfolio investment, direct foreign investment, and we have the third part as the net official reserve. What does this mean? If your country have saving ratio, let's say 5%, what does this mean? All person in your country have $100, but they are saving just $5. And then they want to build up a factory. Okay, they want to make an investment for factory, and the factory prices is, let's say, $15. But in your country, you have a saving in your pocket money, you have $5, and you need $10 additional to build up that factory. You will borrow that $10 from the international market, and this will be your current account deficit. What is the reason behind that? The low saving ratio in your economy. For instance, you can't face these type of things in Germany, Russia, Saudi Arabia, because their saving rate is huge. They don't borrow from international market. They don't have current account deficit. They are financing all their investment with their own money. But Turkey, let's say, huge low saving ratio, and they are borrowing money from international market to finance their investments. Okay. Okay, this will be the last question I'm taking. Abdullamina Kamara. How do you describe a situation in which the money supply is low, but the price of goods and services are rocketing? Okay, perfect question. If you understand this question correctly, you will understand what is happening during last year. The people here is saying that if the money supply is low, what we say a few minutes ago, if you decrease the money supply, the inflation should go down, right? Because there will be no money to demand something. You can't buy anything because you don't have money. But also, let's say we have one product. Let's say this product has 80 supply in the market and we have money. If we decrease the money, the demand will decrease those products and the price of those products will decrease. But the question is saying that, yes, we are decreasing the money supply, but prices is still high, because in the first slide, I said the economy is not just driven by demand condition. Supply chain constraint and supply side is also important, because there is no 80 supply of that product anymore. It is decreasing because of the supply chain constraint. If the production decreasing, if the supply decreasing, even you have low money supply, the prices is going up again. Okay. So I should say my thanks to all followers and all contributors in this presentation. I tried to cover all topics. I will share the presentation as well, and the analysis also recorded. The presentation is also recorded, so you will see all presentation and slides there as well. Thanks you for all your contribution, question, and listening.
Thank you. See you later.